Welcome to Chapter 8 of Essentials of Healthcare Finance, the General Principles of Accounting. The financial viability of a healthcare organization is the result of numerous decisions made by a variety of people, including caregivers, administrators, boards, lenders, community members, and politicians. These decisions eventually result in the organization acquiring and using resources to provide services, incurring obligations, and generating revenues. One of the major roles of accounting is to record these transactions and report the results to interested parties. In this chapter, it will show how a series of typical transactions of a health center are recorded on the books, and how these records are used to produce the four major financial statements of a not-for-profit business-oriented healthcare organization. In the accrual basis of accounting, revenues are recognized when earned and expenses are recognized when resources are used. The accrual basis of accounting must be used in healthcare organizations. The major rule for recording transactions using the accrual basis of accounting include at least two accounts must be used to record a transaction, increase or decrease an asset account whenever assets are acquired or used, increase or decrease a liability account whenever obligations are incurred or paid for, and increase a revenue, gain, or other support account when revenues are earned, a gain occurs, or other support is received. Increase an expense account when an asset is used. The learning objectives are to describe the differences between financial and managerial accounting, understand core principles of accounting that guide the preparation and dissemination of financial information, discuss the differences between the accrual and cash basis methods of accounting, list the three categories of net assets, and discuss the accounting conventions that affect the application of accounting principles. So what is financial accounting? Financial accounting is the branch of accounting that provides general-purpose financial statements or reports to aid many decision-making groups, internal and external to the organization, in making a variety of decisions. An example of financial accounting document are the financial statements. What is managerial accounting? Managerial accounting is primarily concerned with the preparation of financial information for specific purposes, usually for internal users. An example of a managerial accounting document would be a budget. Some key accounting concepts are entity, which means the entity for which the accounting statements will take place. It may be different from a legal entity. Money measurement. An accounting transaction must be able to be expressed in monetary terms. Defines economic resources and obligations. Cost. The price paid to acquire items owned, or assets, by the company is recorded into the financial statements. This is different from the worth of the asset. This will be further explored when we discuss depreciation. Stable monetary unit. Historic and current dollars carry the same value in financial statements. A 2006 dollar is equal to a 2012 dollar. Duality. This concept is the basis of the fundamental accounting equation. Assets equals liabilities plus equity, otherwise known as net assets. Duality refers to the double entry or dual-sided nature of businesses. Every transaction has an opposing transaction on each side of the equation. The principle implies that this equation must balance. Assets. The things owned by the business. Liabilities. Debts owed by the business. Equity. The value of the business after accounting for liabilities. Its net worth. Also what the business owes its owners or investors. Business transactions. During the normal course of business, transactions take place that impact the financial standing of the company. Buying and selling goods and borrowing money to purchase equipment are examples. Because of duality, each transaction must balance. A transaction that increases total assets must also increase total liabilities or owner's equity. A transaction that decreases total assets must also decrease total liabilities or owner's equity. And some transactions may increase one account and decrease another on the same side of the equation. For example, one asset increases and another decreases. Recording transactions, cash versus accrual accounting. Cash accounting. Transactions are recognized when they are received or paid. For example, recognizing sales revenue when the customer pays the bill. Accrual accounting. Transactions of a business enterprise are recognized during the period to which they relate, not necessarily during the periods in which cash is received or paid. For example, recognizing sales revenue when the customer invoice is sent. Knowing your debits and credits. When you look at assets and liabilities, when an asset increases in its debit, it decreases its credit. Liabilities decrease the debit and increases the credit. Same applies to revenues and expenses. Bottom line is that there must be a debit for every credit. It's part of duality. Revenues and expenses. The expanded accounting equation breaks out owner's equity into two components, revenue and expense. Revenue, money the business generates for providing goods and services. It increases equity. Expenses, money the business spends to maintain and grow operations. It decreases equity. Drawings or dividends, money paid to owners. Drawings are proprietorships and partnerships. Dividends are to corporations. The business's profit equals revenue minus expense. The expanded accounting equation looks like this. Assets equals liabilities plus equity plus revenue minus expenses minus drawings. Fund accounting, a system in which an entity's assets and liabilities are segregated in the accounting records. Unrestricted net assets, temporarily restricted net assets, or permanently restricted net assets. Accounting conventions. Conservatism. Lower of cost or market rule for valuing inventories and marketable securities. Materiality. Permits certain transactions to be treated out of accordance with generally accepted accounting principles. Consistency. Limits the accounting alternatives that can be used.